media is very, very consistent. They are always wrong. Always. And so it's not an either or thing.
Right.
We didn't get out of digital to go into green tech, and we're not getting out of green tech to go digital. We do both. We have dedicated partners in every practice. So there's a dedicated practice, individuals that spend all of their time focusing on digital investments. So they will invest in social networking companies, smartphone companies, enterprise software companies. Likewise, there's a dedicated set of partners that are focused on green tech. Okay. We'll invest in solar and wind and transportation and storage, efficiency, those kinds of things. And so I happen to lead our green tech practice here. Okay. Probably 14 partners, senior and junior people that are all focused on that, and there always have been. We started, one thing that's different, we started the green tech investing in about 2005.
Okay.
So we did some, our first investment was actually Bloom Energy.
Sure. Yep.
It's a solid oxide fuel cell.
Right.
Burns very, very clean, creates electricity, and we just kind of every year just increased the attention we placed on green tech, and we thought that it was a perfect storm where there was a concern, long-term concern. We don't get anything short-term, so this is a long-term commitment. There was a concern over carbon emissions, global warming. There was a concern over our national security for transportation fuels especially.
Right.
And technology has brought us a long way to start focusing on new materials to build some of these products. Now, your starting question was about us getting into hardware or hard goods or everything. The truth be known, a car company really is not venture capital friendly. Building big coal plants that will convert coal to gas, not venture. Building big fuel plants for converting biomass to ethanol or some other fuel, or even waste management where we take large plants to convert organic waste into energy.
Right.
These are not, the perfect venture capital scenario is a software company where two people write the code, can put it on the internet, find out if the dogs eat the dog food, if you're going to make any revenue or not,
right,
and growing the company. That's the perfect. It happens to be the only business like that in the world.
Yeah.
So you can't really take that software model and port it to anywhere else. So in biotech and in clean tech, it's very different. It's all about inventing a new intellectual property that's going to be disruptive, and then try to get the risk out as fast as you can. So test that risk on customers or on scalable projects, and find out whether you're going to make it work. And once the technical risk is out, you can afford to now put more money in it. If it takes $500 million to build a company, then you're probably going to be, as an early stage investor, you're going to be crushed down. You're going to be diluted down to a very, very small ownership.
Right. That's
why in Fisker's case, it was really important to get a loan from the federal government. So having a large loan gives investors leverage.
Right.
It was really important to be able to buy the General Motors plant from GM for a very small amount of money. So there's probably $1.5 billion worth of capital that investors do not have to put into
sure.
And that's really great. And that's what makes it somewhat attractive venture capital.
Right.
But we're not in the business to create more car companies. It's not a capital intensive company, is not very friendly for venture capital.
So what was it about Fisker then specifically? Because you've got a number of companies there in the valley. Obviously, the one just down the road from you, Tesla. What was there about Fisker that you said this is something we're going to take a shot at?
Yeah, great question. It really became, I looked at every EV project back as far as 2005, 2006, 2007. I think I saw them all. And every one of them had a major compromise. So it might be, if it was all electric, it would be range. So the car would only go 80 miles.
Right.
And a lot of these projects, the entrepreneurs that develop these projects they were more interested in improving their technology than building a company. So they forgot that they're really in a consumer products business.
Yeah.
Consumer is a very, very difficult judge to please. They vote with their pocketbook. And so they're not going to pay extra to be green. They're not going to pay extra to get less. In other words, I'm going to pay $10,000 or $20,000 more to get a smaller, less comfortable car that doesn't go as far, just to be green. It's just not going to work as a business. So Fisker was the first and only project I've seen that doesn't compromise. There is no compromise for the consumer. So I get a car that's more beautiful than any other car in its category.
Yeah.
A car that is comfortable, luxury. I'm buying a $100,000 car, so it has to have some luxury to it. I am not compromised on range at all. It'll go as far as any internal combustion engine car. It will satisfy 80% of my driving on electric. So I only use gas when I need it to go the range.
Right.
And it costs less than comparable cars. That is a key thing that I thought was very attractive in that. Now, you could argue that we priced the car too low, but I look at the Porsche Panamera, a car that comes very close to the Karma, which is an internal combustion engine car. It's 120, 130,000 if you start putting trinkets on it. High-end Mercedes, high-end BMW are very expensive, more expensive than the Karma. The Maserati Quadriport, which is a car that's very popular out here. You see them all over the place. They're $130,000. So this car is actually, most people I talk to say it's only $100,000. I know it's to the mass market, it sounds like too much money.
Yeah.
But we want to carry that concept. So for a luxury car, it's actually underpriced.
Yeah.
Want to carry that concept down into the mass market. So when it develops a very, very, a good platform for the mid-market and delivers it to the mid-market, we want to be underpricing a BMW 5 Series or underpricing a Mercedes C Series or something like that. And I think this will be a very successful company if we do that.
Okay, good. Look, I read that you once served as the chairman of Think North American. It's a company that's had its ups and downs, and currently, I guess, it's sort of back up, trying to get back in business again. A friend of mine estimated recently that he calculated as much as $1 billion has been invested in that company over the 20 years. Since I first saw that car, actually over on Alameda Island back in, I think it was 1998 or 1999, something like that. And it still continues to be, kind of a troubled company. Even after that level of investment, it doesn't seem to just be going anywhere. And I'm wondering, is that sort of, do you think, symptomatic of just that particular company, or is it maybe a reflection of the larger issues we face in trying to get this technology into the marketplace?
No, I think it's a company that's afflicted with some of the things I told you about in all the projects I looked at. So very limited range in that car. Okay, so I think it's like 80 miles.
Yep. Top
speed is 70 miles per hour. It was developed as a European city car. It's based on a sodium battery, what's called the Zebra battery.
Right.
Although they can change that quickly, and they did write an agreement with
Interdel
to change that to a lithium manganese battery, which is much better, not sensitive to temperature like the sodium battery is. Venture capitalists are like consumers. We kind of vote with our pocketbook too. So we only invested $2 million in Think. The reason we invested, I did not invest in Think Corporate because of all the issues I just talked about. With another venture capital firm that had an idea, they said, let's invest a little bit of capital and own half of the rights to North America when they bring a car that is suited to North America.